Hello everyone, I'm glad you're joining us today because we're diving into a topic that affects every single one of us: money. Whether you're a student, a working professional, or planning for retirement, understanding your finances is more important than ever. Today is January 5th, 2026, and we need to talk about money, specifically what's happening in the UK with borrowing and home buying. These are two areas that touch almost every household, and recent changes could impact your daily life in ways you might not expect. The Bank of England just released new numbers that reveal a lot about the country's financial health. These figures aren't just statistics, they're a window into how people are feeling about the economy and what they're actually doing with their money. These trends impact your ability to get a mortgage, use a credit card, and plan for your future. If you're thinking about making a big purchase, or just trying to keep your budget on track, these numbers matter. Understanding the economy isn't just for experts, it's for anyone who wants to be in control of their financial destiny. The more you know, the better equipped you are to make choices that work for you and your family. When you know what's going on, you can make smarter decisions, like whether now is the right time to buy a house or pay down debt. It's about being proactive, not reactive, with your money. The data we'll discuss covers November 2025 and shows a fascinating contradiction. It's a snapshot of a moment when the financial landscape was shifting in unexpected ways. Fewer people were approved for mortgages, but borrowing for other things, like shopping and personal expenses, jumped. This tells us a lot about consumer confidence and the pressures people are feeling. We'll break down what this means for you and your wallet. Are people spending because they feel secure, or because they're struggling to keep up? We'll explore the reasons behind these choices. Why are home buying and personal borrowing moving in different directions? What does this divergence mean for the average person, and how might it affect your own plans for the year ahead? We'll also hear from an expert who studied these figures closely. Their perspective will help us understand not just the numbers, but the stories behind them. His insights will help us see the bigger picture behind people's spending habits. We'll look at what's driving these trends and what they could mean for the months ahead. The financial climate is always changing, so you need to be prepared for what's next. Staying informed is the first step to staying ahead, no matter what the headlines say. By the end, you'll have a clearer understanding of the UK's economic situation and how to navigate 2026. You'll be ready to make choices that support your goals, whatever they may be. Let's get started and get smart about our money. Your financial journey starts right here, and together, we'll make sense of what's happening and what you can do about it. Before we dive into the numbers, let's clarify our terms and set the stage for what we're about to explore. Understanding the basics is crucial before we get into the details. A mortgage is a large loan used to buy a property, typically a home, and it's paid back over many years, often decades, along with interest. For most people, it's the biggest financial commitment they'll ever make. Getting approved for a mortgage means the bank has carefully checked your income, debts, and credit history, and decided you're a safe bet to lend to. This approval process is thorough, and not everyone qualifies. The number of mortgage approvals is a key sign of housing market health. When approvals rise, it often means more people are buying homes, which can boost the economy. Consumer borrowing or consumer credit is different. It's money borrowed for everyday life and big purchases that aren't a house, like a car, a holiday, or even just covering monthly expenses. This includes credit cards, personal loans, and overdrafts. These debts are usually paid back much faster than a mortgage, but they often come with higher interest rates, making them more expensive if not managed carefully. The Bank of England tracks both types of debt because, together, they reveal how confident or cautious people are about their finances and the wider economy. Are people feeling secure enough in their jobs and income to take on a mortgage and commit to years of payments? Or are they comfortable borrowing for other expenses, like shopping, travel, or managing unexpected bills? A rise in mortgage approvals suggests optimism about the future and confidence in the housing market. But a rise in consumer borrowing can mean two things. People might feel secure enough to spend more, or they could be struggling to make ends meet and relying on credit to get by. Understanding this distinction is critical for anyone trying to make sense of the economy or plan their own finances. The latest data presents a mixed signal, with some numbers pointing up and others down, so let's look closely at what's really happening beneath the surface. These trends matter for your financial decisions, whether you're thinking about buying a home, taking out a loan, or just trying to manage your money wisely in uncertain times. Let's get to the heart of the matter. The Bank of England's report for November 2025 shows 64,530 mortgage approvals. That's tens of thousands of families making moves on the property ladder. Meanwhile, net consumer borrowing jumped by £2.08 billion, the biggest monthly increase in 2 years. This means people took on new debt much faster than they paid off old debt. The surge happened through credit cards, personal loans, and car financing. On one hand, we see long-term planning with mortgages. On the other, a spike in short-term debt and spending. These numbers reflect millions of individual choices across the country. Our job is to understand what this says about the UK economy and your place in it. Let's focus on the housing market. November saw 64,530 mortgage approvals, a slight dip from October's 65,010. It's not a dramatic drop, but it signals a cooling in the property market as the year ended. Economists expected around 64,400 approvals, so the actual number was right in line. This small decline was anticipated and isn't a sign of crisis. Why the dip? Seasonal slowdowns and uncertainty about taxes or the economy can make buyers pause. Buying a home is a huge commitment, so even minor uncertainty can cause hesitation. For buyers, this means the market isn't overheated. There's a bit more breathing room. Competition may ease, but demand remains strong. The market is taking a breather, not collapsing. If you're looking to buy, this could be a good moment to prepare. Stay alert, but don't panic. Now, let's talk about the real surprise: the explosion in consumer borrowing. November's £2.08 billion increase was a big leap from October's £1.713 billion. Something changed. People became much more willing to borrow and spend. Experts didn't see this coming. Forecasts were much lower. When actual borrowing far exceeds predictions, it's time to ask why. This surge pushed annual consumer credit growth to 8.1%, the fastest in a year and a half. People were either confident or feeling pressured to use credit, especially as the holidays approached. It could signal economic strength, or it could mean people are struggling with the cost of living. The truth is likely a mix of both. This pattern isn't a one-off. It's part of a broader trend. We need to understand what's driving it. To make sense of these signals, let's hear from economist Alex Kerr at Capital Economics. He has been closely monitoring the economic trends and consumer behavior over the past few months. He says the strong rise in consumer borrowing shows household demand was solid in November, despite talk of future tax increases. This indicates that people were confident enough to spend, even with the looming financial uncertainties. People kept spending, likely because most tax hikes were delayed and didn't feel like an immediate threat. The delay gave households a sense of temporary relief, allowing them to maintain their spending habits. The pre-holiday borrowing spree wasn't stopped by future worries. Shoppers were eager to make the most of the festive season, contributing to a significant boost in retail sales. But Kerr warns, this surge may have pulled forward spending from 2026. This means that the spending we saw in November might have been at the expense of future months. If you've already stretched your budget, you can't keep borrowing at this pace. Households need to be cautious about overextending their finances. The November spike could mean less capacity for spending in the coming months. This could lead to a slowdown in economic activity as consumers tighten their belts. The strong borrowing is a sign of resilience, but also a warning. It shows that while consumers are willing to spend, they are also taking on more debt. This level of debt growth isn't sustainable, especially with higher taxes ahead. Households will need to adjust their spending to manage their debt levels. Expect consumer spending to slow as 2026 unfolds. The initial surge in borrowing and spending will likely taper off. The party was in full swing in November, but a cleanup bill is coming. The festive spending spree will have consequences that need to be addressed. Be ready for a shift in the economic mood. The optimism of the holiday season may give way to more cautious spending. Don't get caught off guard. Prepare for the changes ahead and manage your finances wisely. We can't ignore government policy, especially taxes. In November, Finance Minister Rachel Reeves announced £26 billion in tax rises. Most of these increases are delayed, so households didn't feel the impact right away. That's likely why borrowing and spending stayed strong in November. But delayed doesn't mean denied. These tax hikes are coming in 2026. Many families will see their take-home pay shrink, squeezing budgets. If you've taken on more debt, Your monthly payments will rise just as your income falls. This combination is a recipe for financial stress. Saving, investing, and even covering basics will get harder. Prepare now for a tougher financial landscape. Let's bring this back to you. The dip in mortgage approvals could be a window of opportunity. Less competition, more room to negotiate. But lenders are still strict, so get your finances in order. Pay down consumer debts aggressively. Banks will look at your credit card balances and loans. The less debt you have, the better your chances of getting a mortgage. Don't let rising consumer borrowing hurt your prospects. Be the person reducing debt, not adding to it. Now, about credit cards and loans. The surge in borrowing is a red flag. Resist the urge to live on borrowed money, especially with tax rises coming. High-interest debt will eat away at your income and wealth. Create a budget, track spending, and cut back where you can. For home buyers, get mortgage ready now. For everyone, the rise in debt is a warning. Prepare for a tougher year. Take control of your money before circumstances take control of you. What's ahead for 2026? The burst of consumer spending we saw in November isn't likely to last. As economist Alex Kerr noted, much of that spending may have been pulled forward. People can't keep borrowing at that pace. Expect a slowdown in retail sales and consumer spending. The housing market may cool further, with slower price growth and more balance. First-time buyers could benefit, but much depends on interest rates and lender caution. The biggest factor will be the new tax rises. Less disposable income means tighter budgets. Confidence could quickly turn to caution. Now is the time to build your financial defenses budget, pay down debt, and save for emergencies. The era of easy credit is ending. The smart, secure people are those who act now. Be one of them.